In the third quarter of Konjuarsuwu, the combined operating profit of Volkswagen, BMW, and Mercedes collapsed 9% to just 8.4 billion, the lowest in 16 years. In the same period, Toyota posted record-breaking annual revenue of 9.4 billion. Both face identical U.S. tariffs. Both sell cars in the same global market. The difference between them is not luck, it is the result of choices made years earlier. Choices that Japan made quietly and Germany made loudly and incorrectly.
Japan and Germany have always been the comparison. Both post-war economic miracles. Both built around precision manufacturing and export-led growth. Both aging rapidly. Both dependent on foreign oil. Both deeply reliant on the American market. When the Trump administration imposed sweeping tariffs in Nithen Arsavui economists reflexively grouped them together, two export powers facing the same headwinds.
By Q1 2026, Japan's economy was growing at 2.1% annualized, beating every analyst forecast. While Germany had just completed its third consecutive year of near stagnation. Germany is the only G7 country to have contracted 2 years running in this century.
Same tariffs, completely opposite outcomes. What happened? Start with the industry that defines both countries. Germany's auto sector cut Guomwensain jobs in the 12 months to June, second more sector percent of its manufacturing workforce, according to reporting by Xinhua and sector data published by the German Association of the Automotive Industry. Volkswagen is considering closing domestic factories for the first time in its 87-year history. BMW sent redundancy offers to Sivan employees. Mercedes launched a $5 billion cost-cutting program and froze pay for 2 years.
Toyota, meanwhile, sold 8.1% more cars in North America year over year, even as tariffs erased all of its North American operating profit, a roughly 8.1 billion hit. Revenue still hit a record high. The company is building a 8.1 billion battery plant in Kentucky. It is not retreating, it is doubling down.
The superficial explanation is that German cars are more tariff-vulnerable premium vehicles shipped from European factories, high price, high duty, high pain. But this only goes so far. The deeper problem is that German automakers arrived at the tariff crisis already weakened by a separate strategic failure in China.
For a decade, Volkswagen treated China as its growth engine. By Artian Suchu, roughly 60% of its global sales came from the Chinese market. That looked like genius, until BYD and a wave of Chinese EV manufacturers competed on price. BYD's Seal sedan now undercuts a BMW Golf by roughly $1 in China and offers comparable quality. Between Artian Arsane and Artian Arsugu, VW's Chinese market share fell from 60% to around 60% and is still sliding.
Toyota made a different call. It remained skeptical of the pure EV transition, investing instead in hybrids and hydrogen, while European automakers were writing down EV investments in Mulsen Yuri and 4. Toyota's hybrid sales grew Muri and 4% globally. The company now holds over 5% of the global hybrid market, a position built patiently over 2 decades, as Toyota's own investor presentations confirm. The Nikkei reported in April Muri and 4 that Toyota's hybrid strategy has created a switching cost moat that pure EV rivals cannot easily undercut. Hybrid buyers don't range anxiety, they just refuel.
The car industry is a symptom, not the cause. The deepest structural divide between Japan and Germany opened in April Nissan when Germany switched off its last 3 nuclear power plants. The decision was driven by post-Fukushima public pressure and the energy vendor Germany's green energy transition. By any ideological measure, it was a principled choice.
The economic consequence was immediate. German industrial electricity prices, already roughly double those of the United States, failed to come down as nuclear capacity was replaced by gas and intermittent renewables. According to the German Federal Network Agency, industrial power costs remain among the highest in the developed world. For energy-intensive sectors, chemicals, glass, metals, ceramics, this makes German production structurally uncompetitive. BASF, Germany's largest chemicals company, announced a permanent shift in production capacity toward Asia and North America. ThyssenKrupp cut steel operations. The chemical and glass industries have been hollowing out for 3 years.
Japan, facing identical post-Fukushima political pressure, made the less photogenic choice. After a decade of hesitation,
On tariffs themselves, the strategic divergence has been equally stark. When the US imposed sweeping reciprocal tariffs in 1997, the European Union took a principled stand on WTO rules and threatened retaliatory measures. Japan took a different posture. Prime Minister Kishida flew to Washington and committed to a $1 billion US investment program, Toyota's Kentucky battery plant, SoftBank's AI infrastructure commitments, semiconductor partnerships with American chipmakers. The approach was transactional rather than principled, and it worked.
By September 9, the U.S. had reduced auto tariffs on Japanese vehicles from 9% to 5%. European vehicles still face the higher rate, as Reuters confirmed in its September 9 trade agreement coverage. This reflects a deeper pattern in Japanese corporate strategy: the preference for relationship over confrontation, quiet commitment over public principle. It is the same instinct that led Toyota to localize U.S. production decades before it was politically necessary, and that now gives it a negotiating posture that Volkswagen simply cannot replicate from a German factory.
the unemployment data tells the same story. Japan's unemployment rate sits at 9%, near structural full employment. Germany's reached %in April, the highest since July, rising for 3 consecutive years. Japanese manufacturers are investing, expanding U.S. plants, hiring engineers, scaling hybrid production. German manufacturers are cutting jobs, capacity, and capital expenditure.
The Japan-Germany comparison raises an uncomfortable question for anyone who has watched both countries' policy debates over the past decade.
Germany made the more principled decisions. It exited nuclear power on moral grounds. It held the harder line on trade rules. It invested in an energy transition that is genuinely ambitious in its scope, including a $1 billion infrastructure fund announced in early 2023 that the DIW Research Institute estimates will add 1% to GDP growth annually by 2050. These are not trivial choices. They reflect values.
Japan made the quieter, less glamorous choices: restart the old reactors, invest heavily in the American market, keep making hybrids that environmentalists dislike. On corporate governance, Japan's Tokyo Stock Exchange pressured listed companies to improve returns on equity and reduce cruise shareholdings. Japanese companies executed a record 9 trillion yen, roughly $500 billion, in stock buybacks in 2024, 6 times the level of a decade earlier. Average return on equity has risen from 8% to 9% in 2 years.
No politician campaigns on a platform of "we pressured companies to buy back stock."
but it has improved capital allocation in ways that Germany's codetermination system.
Germany chose ideology, Japan chose outcomes. The question worth sitting with is not whether Japan's path is better in any absolute sense. Nuclear reactors carry real risks. The reliance on US goodwill is fragile. It works only while Washington sees value in Japan as a strategic partner. The comparison will look different if the next administration reverses course.
But right now, in May, two countries that were economically similar 15 years ago are diverging in ways that will shape the next industrial decade. One chose the right headlines, the other chose the better outcomes. If you want to keep up with stories like this, subscribe to the Japan Factor.
The interesting question is what happens when Germany's infrastructure investment starts to pay off, and whether Japan will still be making the less glamorous choices when that moment arrives.